In this video, we're going to be exploring the basics of investing. So, what is investing? Investing just means you're allocating money with the expectation of getting some sort of future gain through some sort of undertaking, such as a business. So, what are some common ways to invest? This might include stocks, bonds, real estate, and alternative investments. So, what are stocks? A stock is an equity share of a company, meaning the owner of a stock is entitled to a fraction of said company. The amount of shares available differs depending on the company, often numbering in the millions. The amount of shares issued by the company, also known as amount of shares outstanding, multiplied with the price of the stock gives an investor the valuation of a company, also known as the market capitalization. Certain companies may choose to issue dividends, or rather, distribute the profits of the corporation to shareholders. However, keep in mind that dividends aren't the only way for shareholders to receive value from a company. Since if a company becomes more valuable, their share price will naturally increase, thus giving shareholders an unrealized profit. So, how can a person buy a stock? Stocks are traded and exchanged in the stock market, which can be accessed through stock exchanges that themselves are accessed via brokerages. So, what are bonds? Bonds are financial instruments that represent debt, meaning if you own a bond, the company or government in question owes you money and will pay you back plus some interest, known as yield, after an agreed date. Different bonds pay differing amounts of interest. However, higher interest rates may signify that the debt is riskier, or rather that there is a higher chance that the government or company in question will be unable to pay you back or go in default. Generally, bonds are seen as a safer investment than stocks due to their relatively certain guarantee of paying you back. However, in exchange for being lower risk, bonds typically have a lower payoff than stocks. Before we dig deeper into stocks and bonds, we have to explain the markets that these instruments are traded on. These markets are subjected to the principle of supply and demand. This principle states that if the price of something increases, more people are willing to sell the object in question. And if the price decreases, less people are willing to sell. This principle also states that if the price of something decreases, more people are willing to buy, and vice versa. The point at which supply and demand are perfectly matched is the equilibrium point, meaning at a specific price, the same amount of buying and selling occurs. However, supply and demand are not static. Rather, it can change at any moment due to news or any other change of external factors. So, a very simplified example of a change might be a company announcing an ambitious expansion plan. Thus, people see the company as a more lucrative investment. Because of this, more people will want to buy the stock, invest, but at the same time, less people are willing to sell. So, there's an increase in demand and a decrease in supply, which leads to the stock price of the company rising. In the stock market, people want to diversify or invest in many companies so their investment isn't only dependent on the performance of one company. However, investing into a lot of companies might not be feasible. This is where ETFs and mutual funds come in. ETFs, or exchange-traded funds, are typically a basket of stocks that are packaged into smaller, tradable instruments. For example, the ETF SPY is an S&P 500 ETF, meaning that it contains holdings in all of the top 500 publicly traded US companies. Now, I say publicly traded companies because many companies are private, meaning their shares aren't traded on the open market and thus aren't available to regular investors. Now, in exchange for making the process of investing in so many companies easier, these ETFs tend to charge a small fee. For example, SPY charges a 0.09% management fee. Mutual funds are also similar in being a basket of stocks, but they're not exchange traded. Rather, the company that creates these funds will take your money and package it into a fund at the end of the day. As such, mutual funds don't really trade on the market since you're only dealing with the company that creates them. Mutual funds also tend to be actively managed. We'll get into the difference between active and passive management in another video later. But because of this, they charge a higher management fee. ETFs are also somewhat more tax efficient than mutual funds, given their management structure. When you invest in stocks, you can buy a stock, known as having a long position. However, you can also bet against the performance of stock, known as shorting. Shorting works by borrowing a share from a broker, and then selling the share on the market in the hopes that after the price drops, you can buy the share back at a lower price and then return it. In other words, you are trying to sell high and then buy low. However, shorting can often be riskier than taking a long position since there is unlimited risk, because a stock can technically rise to an infinite price, and long positions can only drop to $0. When shorting, the position is also more unsteady since, as you are borrowing shares, your broker can close the position for you if the shares need to be returned. And lastly, I want to bring up one last type of financial instrument: derivatives. As you might guess from their name, these are contracts that derive their value from another instrument or asset. Now, all of these instruments that I have mentioned are types of securities, meaning tradable financial assets that hold monetary value. In the US, these securities are all regulated by the SEC, or Security Exchange Commission. That's all we have for today. Thank you for watching.